Welcome to Financial Analysis and Engineering Economics. Reporting on. So once again, welcome to Financial Analysis and Engineering Economics. This is an 8 PDH program. We've gone through some housekeeping stuff already, and the program is being recorded. Let's go ahead and get started. And let's see here. All right. Okay, so this is the list of topics in front of you right now. So first thing we're going to get into is accounting and finance and really engineering, econ, all of that mixed in, those definitions, and some discussion and examples of calculations and so forth. So this is a very important basic finance, accounting, and engineering, econ fundamentals area where we want to make sure that before we get deeper into the program today, that you're on board as far as definitions are concerned. And don't miss out on anything. In other words, if we use a term and we're getting deep into a case study and you're wondering, well, what is that term? Then it would basically, anything we build or you build on that new information will basically be landing on hollow foundations. So we'll try to get all that taken care of, give you all the definitions and all that. So we end up taking our time with this section. And so we'll also then get into economics and engineering economics, and then we'll get into common organizational structures and the role of financial analysts, accountants, controllers, and CFOs, and so forth. And you'll see them kind of embedded in the overall organizational structure, and you can kind of see where they typically are, which layer or echelon in the overall organizational structure they typically find themselves, those roles of financial analysts and accountants and controllers and CFOs. And in addition to them, of course, everybody else who's typically in these organizations, in a typical organization. Now, I said typical, and that's important because your organizations, the organizations you may be in, may be quite different, or somewhat different, and that's normal. In fact, I've been exposed to many organizations in my 30+ years in the corporate world. I've did a lot of work in different facilities and different organizations, and I still do consulting with mainly a lot of engineering type of and energy type of consulting, and in different companies and firms, and I get exposed to different organizational structures. So I see a lot of commonality between them, but also see some bespoke differences between them as well. But that's just the nature of the beast. But with the familiarization that we're going to take you through, you'll have a good flavor of what those functional titles mean, and so whether they end up in one position or another, at least you'll know what they do and what their purpose is. We'll get into income statements and balance sheets. And also talk about cash flows, working capital concepts, and so forth. And this is in the context of really the fundamentals of accounting. In engineering, you've got this foundations that are based on physics. And you got, like, if you're a mechanical engineer, one of the most fundamental laws is the first law of motion, and the second law of motion, and the third law of motion, and the old equation, force equals ma. Those are the very building foundations of mechanical engineering and really all engineering disciplines. And then if you're a double E, you have the most basic law called the Ohm's law. And then if you get into hydrostatics, hydrodynamics, you have these Bernoulli's equations and Darcy's equations and Hazen-Williams equations and all that. So we got in engineering, we got all of these fundamental concepts that all the engineering disciplines are built on or around. And so similarly, when you get into accounting realm, there's that holy grail. There are a couple of entities that almost all accounting anywhere in the modern developed world is based on, is basically based on. And those two entities are income statements and balance sheets. And they indeed are based on equations, and I'll show you that income statement is really an extrapolation of an equation, and we'll see what that equation looks like. And similarly, balance sheet is an extrapolation of an equation which basically equates assets to liabilities and equity. And so we'll cover all of that, and I think you'll, as engineers, you'll be able to relate to that a little bit better as we do through equations in anything we do. And then we'll get into financial reporting. And again, you know, most of you are probably familiar with some of this financial reporting already, and through your 401k and whatnot. If you follow your 401k plans, you probably get these. If you're vested in the stock market, you know, you probably you get these different flyers from your the company that you hold stock in. Those are all required to be published and sent to the stockholders, and you probably get these meeting notices and dividend notices and all that. Well, those are some examples of financial reporting, but not entirely all of it. But we'll kind of expand this concept and talk about, you know, what are typical reports that are required to be put out by corporations that are listed publicly and are basically public, have been IPO'd or are listed on the stock market. And if you're, you know, we're not going to be talking much about privately held corporations, because they're, you know, they can be as completely arcane and secretive and non, you know, public domain as they want to be, and so, you know, so that is not something, and they're usually far and few in between, so we don't get into them. We're basically going to be addressing most of the stuff that's related to companies or firms that are listed publicly. We'll get into financial metrics and ratios, and, you know, if you have done projects, which I'm sure all of you have, you know, when you put the funding request together, after you've gotten your quotes and estimates on large projects, that's what you do, put your funding request together, and then you basically put in the request, submit the request to corporate brass, and hope for approval. And so, you know, when the first thing that happens then is accounting takes over, financial analysts take over, and they do all kinds of financial analysis on them. Some of the financial metrics that they assess on your projects may be somewhat specific to your organization, maybe a characteristic, intrinsic kind of ratios that your corporation dwells on or uses or relies on, but then there are some very common ones that pretty much are found and permeate throughout almost all organizations and all firms, and such as payback period and IRR, ROI, and more and more NPV, which is something that I lend a lot of credence to. And then you'll see return over equity and return over and RORs and so forth. But so bottom line, those are some common ratios you will see pretty much calculated on every project that is submitted for approval, and that's, you know, after those ratios and metrics are calculated, they're passed on to that information is passed on to the upper brass and upper management, because that they want to approve or disapprove a project based on those metrics. So, for example, given organization, the culture I was in before I parted ways and got out of the corporate world, they basically relied heavily on payback period. And meaning, you know, if your project didn't show better than 3-year payback period, you pretty much just forget about it. unless the corporate brass is passionate about the project, or the marketing and sales and marketing folks are passionate about that particular product that's being put in, that the funding is related to, in which case ratios may not matter, or they can basically, those the future prospects of business with the new product alone may basically prop up those ratios. So that's unless your project is favored in those different through those different ways, or because of the different characteristics, you pretty much are judged based on payback period in many organizations. And of course, payback and ROI are interrelated. So one is the inverse of the other, as you'll see. But bottom line, if that's kind of the threshold. Like I said, if the financial analysts show that your project has better than 2-year payback, it'll pay it for itself in less than 2 years, then there's a very good chance it's going to probably get approved, unless there's some kind of an inherent unknown and risk or aleatory nature of it. So that's those are some examples of some of these ratios. And beyond that, you see these other metrics: current ratio, asset test ratio, plant turnover ratio. These are more profound and deeper type of numbers, and they are more investment related, not in a new process line, a new piece of equipment, but more holistic. I mean, if you're trying to put in a new facility somewhere, if WADA were trying to build a plant in the United States and from ground up, greenfield project, that would be going from one country to the other, investing in from one part of the other from one part of the world to another part of the world, or something like that, or even within the same country. When you're doing a lot of greenfield projects, you basically look at current ratios, asset test ratios, plant turnover ratios, and we'll again go deep into them and show you how they're calculated. So that's getting a little bit deeper beyond what you may have come across, the types of metrics you may have come across as engineers so far in your line of work. So that's a bit of background on metrics. Then we'll talk about depreciation alternatives. One of the more common ones is straight line depreciation, which is abbreviated as S/L. And then production-based type of alternatives, but the other more common one is SOYD, as some of the year digits type of depreciation, and then there's ACRS and then MACRS, which are accelerated depreciation alternatives that are made available in the U.S. by the U.S. IRS, and so after explaining the nature and the composition of these depreciation alternatives